Hello friends, welcome to Corporate Bridge. Before we start with understanding of commodity markets and trading in commodities in detail, let's have a quick view at the learning objectives or the contents that we are going to learn in this course briefly. Our course is divided into two parts where first we learn about the commodity markets. Here we look at the meaning, evolution, types, features of commodity. Then the segments in commodity market. We will understand the concept of derivatives in commodities. After this, we'll look at the various participants in commodity futures. With this, we'll end our first part of the course. And the second part of our learning will focus on commodity trading. Here we will know the major commodity exchanges with their functions. Then we will have a look at the advantages, disadvantages, and the various risks in trading. Ahead we'll understand the concept of margin. Then we go on to see the types of orders, lot sizes, trading screen, and demat account. Then we will understand what are the fundamental and the technical analysis which will help us in the calculation of a call. At the end, we see how settlement of a contract takes place. We'll also discuss some recommendations that are required in trading at the end of our course. At the beginning, let's start with first understanding the meaning of a commodity. Every day, people engage in activities that require the use of products. The raw material that go into making these products are called commodities. So in simple words, a commodity is a raw material or a primary agricultural product that can be bought and sold, such as copper or coffee. Commodities are bought and sold in what is called as the cash market. This is sometimes also called the spot market because people pay in full for the commodity on the spot. Now let's see what is a commodity market. A commodity market is a physical or a virtual marketplace for buying and selling and trading raw or primary products. For investor purposes, there are currently about 50 major commodity markets worldwide that facilitate investment trade in nearly 100 primary commodities. Now let's see how commodity markets actually evolved. Commodity futures trading have evolved from the need for ensuring the continuous supply of agricultural crops. In Japan, merchants stored rice in warehouses for future use. In order to raise cash, warehouse holders sold receipts against the stored rice. These were known as the rice tickets. Eventually, such rice tickets became accepted as a kind of general commercial currency in Japan. The concept of organized trading in commodities evolved in the middle of the 19th century in Chicago, United States. That time, Chicago had emerged as a major commercial hub with railroads and commercial lines connecting it to the rest of the world. However, lack of organized storage facilities and the absence of uniform mechanisms confined them to the mercy of dealers' discretion. This led to an inherent need to establish a common meeting place both for the farmers as well as the dealers to transact in spot grain, to deliver wheat and other crops and receive cash in return, and this was in late 1848. Gradually, the farmers and dealers started to make commitments to exchange the produce for cash in future. So this is how the contract for futures trading actually evolved. Now commodities are split up into four types. First division is known as the precious metals, which are gold, silver and platinum. Then we have the base metals such as copper, zinc, nickel, lead, aluminium, tin. Then comes the energy sources like the crude oil and the natural gas. At the end, we have the agricultural commodities such as oilseeds, spices, cereals and other such agricultural commodities. After we have seen the various types, let's look at some of distinguished features of commodities. The first one is deliverability. All the commodities have to be physically deliverable. For example, crude oil can be delivered in barrels and wheat can be delivered by the bushel. However, currencies, interest rates and other financial future contracts are not physical commodities. The next feature is tradability. The commodity has to be tradable, meaning that there needs to be a viable investment vehicle to help you trade it. For example, it is a commodity if it has a futures contract assigned to it on one of the major exchanges. Also, for example, uranium, which is an important energy commodity, it isn't tracked by a futures contract, but several companies specialize in mining and processing this mineral. By investing in those companies, you can get exposure to uranium. The last feature we see here is liquidity. Liquidity means that commodity has an active market with buyers and sellers constantly transacting with each other. Liquidity is critical because it gives you the option of getting in and out of an investment without having to face difficulty of trying to find a buyer or a seller for your securities. Now let's go ahead and look at the various segments in commodity market. There are two major segments of the commodity market. They are the over-the-counter market and the exchange-traded market. Let's understand each one of them now. Over-the-counter means that there is no formal structure of trading and parties trade on the basis of bilateral understanding. In terms of commodity trading, over-the-counter or OTC represents spot trading of commodities. Since the structure is not formal, it is also referred to as a customized market. Almost all the trading that takes place over in these markets is delivery based. It is entirely unregulated with respect to disclosure of information between the parties. Therefore, the trade that takes place are subject to counterparty risks. Next comes the exchange-based trading or exchange-traded markets. It is also known as the derivatives market, and it is a place where commodities are traded over the exchange. It is standardized in nature and decently regulated. An exchange acts as an intermediary to all commodity transaction, and it takes an initial margin from both the sides, the buyer and the seller of the trade, to act as a guarantee. We'll understand this concept of margin in detail in our future videos. As you know, these commodity markets are very volatile. There are various factors which affect the commodity prices. Let's now look at those factors one by one. First is the demand and supply. When demand for a commodity is higher than the supply, its prices increases, and vice versa. There's always some imbalance between the two when it comes to commodities, which results in constantly fluctuating prices. Next is weather conditions. A majority of commodities traded in the world markets are agricultural goods, and the production of these goods depends on the weather. Sudden changes in the climatic conditions like inadequate rainfall or droughts might affect the availability of agricultural goods in the world market, which causes scarcity and pushing commodity prices northwards. The prices of commodities are also impacted by the economic and political conditions of the countries that are producing and consuming those commodities. For instance, during the Gulf War in Iraq, which was a major producer of oil, the price of oil fluctuated very frequently. Moreover, weak economic conditions reduce the spending power of consumers, which leads to fall in the demand, which again leads to movement in prices. Now let's see how government policies affect commodity prices. Any change in government policy, especially the ones impacting the import-export cost to the buyer or the seller, will have a huge impact on commodity prices. If, for instance, the Indian government increases the import duty on edible oil, its price will show a proportionate increase, vice versa. Then there are some factors like inflation, seasonal variations, currency movements, etc., which are majorly responsible for price fluctuations in the commodity market.